Hey everybody, this is Randy Pearson, Vice President for Life and Annuities, and I'm sitting here today with my good friend and top RVP with Gordon Marketing, Paul Bechtold, who also manages our Your Family Bank program. And today we're going to be talking about an often misunderstood aspect of the Your Family Bank program, and that's how the loan mechanism works. So if you'd like to learn more about that, be sure and stay tuned. All right, Paul. So, life insurance loans in general, whether you're talking about whole life policies or IUL, newer policies, older policies, most advisors out there really have no clue on exactly how that mechanism works. So today we're going to chat a little bit about that. Can you give the agents that are watching this video a little bit of a start to the subject matter today?
Sure, Randy. Well, obviously with the Your Family Bank program, we're designing it from the beginning and kind of conveying to the client that there's going to be loans taken from the policy. So it's something you have to embrace. It's something you have to understand at a rudimentary level. So first, let's talk about the process of taking a loan, which isn't difficult at all. Whenever we want to take a policy loan from any insurance carrier, there's usually a one-page loan request you fill out. You fill out your name, policy number, you sign and date it, and you send it to the carrier. And usually within about 5 business days, that money is transferred to you either via a check or an EFT wire transfer back into the bank account of your choice. Okay. Really no big deal at all, right?
All right. So, anytime we're talking about loans, whether it's life insurance loans or auto loans or mortgages or whatever, there's an interest rate charged. So with most carriers, or at least with the carriers we use within the Your Family Bank program, what kind of interest is the consumer, the policy owner, paying?
Well, our best carrier that has the most favorable loan interest, we're talking about a 4.76% interest rate. Okay, right. So very competitive in today's interest environment. It'd be difficult to go get any kind of a loan anywhere at that kind of an interest rate level, right? Yeah. But one of the things I'd like to point out is that a life insurance loan has a couple of unique characteristics that no other loan has. One is there's no structured payment that's required on that loan, okay? So even though we've taken a loan out, when we take a loan, we got to repay it back. There's no structured payment. There's also no structured timetable because any unpaid loans ultimately just come out of the policy death benefit at the time of death if they're unpaid. Okay, so it really creates a great scenario where we're actually spending our own death benefit in our own lifetime.
Excellent.
By taking a loan.
And certainly unlike a typical loan, like I just described, an auto loan or a mortgage or any other kind of loan, the consumer doesn't have to qualify for the loan, right? I mean,
That's
it's
correct.
their policy.
Yes.
So they're utilizing their cash in their contract as collateral, and it's just simply a process. But I know that there's different kinds of interest in the world of finance. What kind of interest are we talking about within this YFB program?
Okay, so that's an interesting question, and that's step 2 of it. So first we want to talk about the process of getting the money out, and then how is the loan interest actually calculated? Okay, so when you take a policy loan from a life insurance policy, the carrier charges you simple annual interest for the entire year on that loan. So let's just use an example of, we're going to take a $10,000 loan from one of our other carriers that say has a 5% loan rate, right? Mm-hmm. They're going to charge you $500 for the entire year for that loan. Okay, now there's 2 ways you can pay it. You could strike a check and send it into the insurance company to squelch that loan interest cost out, okay? Or you could use subsequent repayments to it to pay the loan balance down. What happens is when we repay the loan to our policy, we are credited back all the months of non-use of that interest. So let's just use, for example, we took that policy loan of $10,000 out at 5% interest, and we had it all paid back in 9 months. So we used the policy loan for 3 months. We would get credited back 9/12 of the interest back to ourselves for the unused portion of that interest.
Okay. All right, very good. I mean, let's look at worst case scenario. What happens if the policy owner / consumer chooses not to or can't repay the loan? What are the consequences?
Okay, well that's interesting because now if they can call it simple interest because they're charging you for the entire year, and if you pay that interest off within the year, it is simple interest. But any unleft interest balance at the end of the year gets charged another annual simple interest charge the next year. So it effectively becomes compound interest at that point, right? You're getting interest charged on principal and interest, okay? So leaving lingering policy loans out there can accumulate on you over time. But here's where the real value comes in, okay? If we're only borrowing a portion of the total cash value, that total cash account is still earning compound interest that's outpacing the loan interest cost. So even though we haven't paid it all back, it's still costing us less in total than what we're earning in the policy.
Okay, so, well, once again, staying on this line of thinking of worst case scenario, is there ever a situation where the loan interest could literally become so great that it erodes the entire cash value of the contract?
Well, there's a couple of safeguards that are in place. Number one is the carrier will not allow you to borrow any more than about 95% of the available cash balance in the policy. The other thing is they safeguard that and take into account the amount of money that you already have out on loan. So it creates an overloan protection that the carrier safeguards themselves with. And then the other thing to be aware of is, the carriers that we have, you can take loans as early as, with one carrier, 10 days and the other one 30 days, okay? But this carrier is going to safeguard the next premium payment that's due so that they're not caught short while you have an outstanding loan. So one of the questions we get a lot is, well, I've been paying into this thing for 2-3 months. I should have this amount in there. Why is that amount not available? The carrier has safeguarded the next premium payment to make sure that they're not caught short.
All right.
So.
Well, we're running out of time here, but it's really kind of amazing, and I'm sure that most agents out there aren't aware that you could literally fund a life insurance policy and within, say, 7 to 30 days, borrow right back out of that policy.
Absolutely.
If you're an agent out there and we've intrigued you on the subject matter, which, once again, a lot of advisors aren't familiar with the mechanisms of loan provisions within life insurance contracts, but if we've piqued your interest, please do me a favor and reach out to Paul Bechtold, the manager of our Your Family Bank program. He'd be more than happy to talk you through that. But for now, we have to take this episode of Selling Life and Annuities to the end. If you wouldn't do me a favor, I'd appreciate it if you would click subscribe and the notification bell at the bottom of this video so that every time we come out with content, you'll be notified. But for now, from Paul Bechtold and myself, happy selling.
Have a great day.